FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. It's 7/23/19. Well, Bitcoin contest is over. We got our winner. I mentioned it before. His last name, I believe his name is Mike Redlark, and he guessed it within less than $19, which is pretty remarkable. We'll be doing other contests, I promise you. So get on the list. Email us kl@kerrylutz.com. Well, what in the world is going on here? We're in the midst of this wonderful recovery. Why is the Fed even thinking about cutting rates? It's counterintuitive. It makes no sense. If anything, they should be raising rates now at this stage of a so-called recovery. Well, someone who's got her take on this, who will certainly help answer that question, is Danielle Park, jugglingdynamite.com. Danielle, it's great to have you back. So why are they cutting rates if everything is so great?
Yeah, well, the thing is, Kerry, they always cut rates at the peak of, for example, the expansion or near the peak of an expansion when things are typically, the backward-looking indicators look really robust, and the stock market is very often at or near an all-time high. Unemployment is usually at or near an all-time low when they start to cut rates. And that's because they're trying to look forward, right, at the incoming data. And the data there has resoundingly been negative in the last, for the last 6 months for sure. And overall trends even further out than that. The economic cycle essentially peaked in about 2011 and has been on life support in this slowest recovery of all time, lowest growth rates. And then the IMF just cut its forecast again over the next 2 years. And everything that's coming out lately, certainly in terms of the global economy and in terms of the U.S. economy, the forward-looking stuff is what's really ugly. And that's what's prompting them to want to take preemptive measures, which is all typical behavior. The concern here is that, of course, they are doing so when they have so little room between current policy rates and zero, right? When, in past cycles, they would have 500 basis points of room or so to try and re-stimulate. And even when they started cutting in those previous cycles, they had to slash for, many months before new borrowing kicked in. So the concern here is that not only do they have this, only 250 basis points of room potentially before they're at zero in terms of policy rates, but you've also got that much more debt worldwide. So, that is a difficulty along with flat wages. So as soon as you get any bump up in the unemployment rate, when, it starts to increase, and you have flat wages, which we've had throughout this so-called recovery, there's no cash flow, right, to fund further increases in consumption. And that's why revenues have been flat for a long time here. Actually, S&P earnings have been flat for the last 4 quarters if you back out the buybacks, which have been the primary buyer of equities. So there isn't much robust stuff here to make them think that they want to wait on rate cuts. That and their terror that they're going to get a backup in the, a sell-off in equities again, like they saw at the end of the year. Because as I've said many times, the equity market's really their only post of that they can sort of brag about, and what Mr. Trump likes to brag about, President Trump likes to brag about the stock market being a high, as if that's a positive, but in reality, cycle highs in the stock market are more foreboding of the downturn than of anything else.
Yeah, that's very true. And, well, one thing is these employment numbers, I don't think they're cooking them, have looked really good now for 2 years. The new claims for unemployment insurance have been at generational lows. They did pop up a few times, but not for very long, 1 or 2 weeks. They're mostly seasonal, but now we haven't really seen them go up. Are we only going to know after the fact when they start going up, or are we going to get some indicator?
I mean, we have seen pretty broad layoff announcements in the last year or so. I mean, certainly in finance and energy, we've had quite a lot of layoffs, at least conventional energy. Alternative energy jobs have been growing quickly, but from for example, oil and gas sector, you've seen quite a bit of layoffs. Finance keeps downsizing itself because it's this gargantuan monster that's been blown up on cheap credit for the last decade. And, it's going to have to retreat as asset prices come back down. So you got a lot of pricing pressure. And so I think, I get it that the unemployment rate remains low, but as I say, that's a late cycle typical marker that you'll see. And also, of course, you have issues with the participation rate now in America and in other major countries where you just haven't had, and a lot of the people that are working are doing so at various jobs, not just sort of one solid occupation. So the risk here is certainly that unemployment is rising and will continue to do so over the next couple of years.
Mm-hmm. So they're being proactive. Eh? Is that what it comes down to?
Well, that is their theory, right, is that they have to try and be proactive. In fact, their history or record of being proactive is horrendous because they always want to leave rates low as long as possible. And in this case, did so maniacally. I mean, like literally almost to the point of, just reckless disregard, the fact that they left rates so low for so long. And not only that, they're still doing quantitative tapering right now, and that's going to stop in September. So they're really concerned on many levels about, not just unemployment rising. That's one of the things that they inevitably will have to contend with here. But it's this fragility in financial markets. There's some very disturbing things going on in corporate debt for sure, but in liquidity evaporation again. In the repo market, in the overnight market, a lot of the credit markets are showing signs of great strain. We've got a ton of negative yielding debt in European markets, but even in places like North America, there's just a lot of concern because the Treasury market is still getting the bid here, even as junk debt has gone up in price the last 6 months as well. Rising treasuries and rising stocks are normally incongruent, and someone's got to give here. Something's wrong, and I think that the Fed is also very concerned about the extent to which we've got these intermediaries and knockoff effects if we start to see vanishing liquidity as we have.
Yeah, it's a little scary down the road. It looks okay right now. Everybody's kind of happy, but everybody's kind of nervous, and it seems like all of these indicators, and then we've got precious metals making a comeback after being nearly 10 years in recessionary territory. They've gone up significantly since the past few months.
Yeah, so bullion's up about 13% in the last year, I noticed. Mm-hmm. Silver's up too. That's interesting as an indicator of more of manufacturing demand in the world. A lot of silver goes into things like semiconductors, but yet semiconductor sales have been falling for many months and are at the lows of the cycle. So there's a lot of, reasons why people may buy or speculate in things like gold and silver. And I think the argument here is not so much about inflation, because I don't think inflation is, in a world dominated by debt and aging demographics and technological innovation, disinflation and deflation have the dominant hand in this environment. So I don't think it's a argument about inflation, but obviously with regard to stability and concerns, flight to safety, concerns for alternate places to store money, you certainly have seen some flows into precious metals. And we'll see, the gold companies themselves have been, up in year to date for sure, but they're still sort of negative since 2016 and 2011. Mm-hmm. Which were their latest tops. So we're not seeing a lot of follow through to the producers in this. And so if you thought there was going to be a lot of demand for the commodities, you'd think you would see more in terms of price appreciation in the producers. And that's not following through right now.
Yeah, well, the GDX and the GDXJ are up substantially. Barrick, Newmont, they've both gone up. They've both had runs here. The large majors, right?
FSN Radio. It's all about what's next.
Financial Survival Network is brought to you today by Orin Resources, a junior exploration company with the appetite of a major. It's hot on the trail of the next globally significant discovery, creating enormous potential upside for you, the shareholder. Orin is one of the most aggressive exploration companies pursuing high-grade, scalable gold and copper deposits, and has a premier 7-project portfolio, including its 2 flagships, Committee Bay in the Arctic and Sombrero in Peru. Orin's unparalleled technical team and highly experienced management has a history of success in advancing and monetizing exploration assets. No wonder Orin's been called one of the best in the junior exploration sector. Orin trades on the TSX and the NYSE under AUG. To learn more, go to orinresources.com. That's AURYN resources.com.
The Financial Survival Network. It's all about what's next.
Yeah, I'm just saying, in a short-term window, I agree with you, but to the extent that I trust anything that's bounced year to date, I remain skeptical. I think that the downturn that began in the global markets and economy, as I say, the economy's been in a downturn for over a year. Earnings have been as well. Small cap earnings like credit flows are all retreating. I think that the bump that's happened in the last few months has been largely nonsense generated. And so we'll have to see when we get into the real sell-off phase again. And this is where the test comes in for things like precious metals on a safe haven argument. Right. You have to see how they respond when everything else starts selling off. As you said, even cryptocurrencies recovered in this environment, right? Yes. So there was this general risk-on flavor, and it saw capital flow into everything at the end of last December for the first sort of 7 months of the year, 6 months of the year. And now the test is going to be when we see that the next wave of selling pressure, to what extent those things decouple. And that remains to be seen. They didn't do so great in past cycles, let's say since 2008, when you had dramatic drops. Certainly the shares of the companies themselves dropped, and the commodities themselves disappointed in terms of a hedge. So the question is, will this time be different? And I can see arguments for why it may be the case. My concern goes back to general illiquidity. And when you've got a bunch of people with a lot of illiquid assets on their balance sheet, a lot of companies, corporations, a lot of individuals and pensions, and not enough cash at the ready, then you have sort of forced selling of pretty much every asset type, especially when institutions in between themselves are strapped for liquidity. And I think that poses a threat to all asset types of every kind, when people basically will sell whatever they can, whether it's what they want or not, just anything.
Yeah, it's very true. Nope, good point. So we haven't seen the confirmation rally yet in the gold stocks, I guess is what you're saying. We have to see that to really know for sure that this latest rally is the real deal. Although I think there's a lot of technical indicators, higher highs, higher lows, broken resistance points that now have become support levels. So my guess is it's probably for real, but we need to see more.
Yeah, and the upside, what is the upside goal? And the thing that I find more practical in this discussion is, what are the individuals that are wanting to participate in that space? What are their rules set around it, right? If it's just trying to reclaim the peak from 2011, the top we saw in for example, the price of gold and silver in sort of the fall or late summer of 2011, is the test to reclaim that? And if that's the test, then when will we know that we're into any kind of new upward momentum? And is that, if it breaks through that, and if it doesn't, if it fails, it's failed so many times in the last 6 years in this trading range, from the peak in 11 to now. It's been sort of sideways, range bound. And yes, we're now at 1422, for example, on bullion. But as I say, we won't know what legs this really has until we see the strain come into other asset classes.
Mm-hmm. Yeah, well, it looks like interest in the sector is picking up. That much I will say. But how much is anybody's guess? And like you said, we need further confirmation. My gut feel tells me I think we're in for a resurgence of inflation, because the central banks are just look how expansionary they are, Danielle. Look what they've
how
been
about
doing.
what they've done this now for how many years, Carrie? They've been being more and more aggressively expansionary, and they're going to try and do it again. But what keeps happening? They keep missing their inflation forecast, right? They're nowhere close to the inflation that they've been targeting. So it just proves, and there's so much good work out there. Gary Schilling's done some excellent work on this over the years. Hoisington has done some excellent work on this, Lacey Hunt and others. But basically just documenting the reality that when you have this much debt in the world, when you have aging demographics, and when central banks keep adding with every blip or downturn, they forced more debt into the system, you ultimately have less consumption over time, not more. You have lower wages, which is the primary driver of inflation. So to what extent is more monetary easing going to be successful this time when it's been unsuccessful on a sustained basis for more than a decade? And that's where I have my doubts.
It might well be the case, but at the same time, we've seen asset inflation, whether it's housing prices, stock market, bonds, every type of asset have gone up dramatically. So
for example, let's look at that one for housing. I was writing about that today on the blog about the housing market in Canada and the reality that rents are in the extremely unaffordable category for Canadians. So rents and housing costs. So if you look at, property taxes, utilities, and mortgage costs, as well as rents, they're all more than 50% of household disposable income. And that is considered extremely unaffordable. So yes, you've seen asset inflation, but what does that ultimately do? It means people have a lot less funds to buy everything else, to consume other things, right? And so when they have a lot less funds to consume other things, you don't get sustained inflation across the board. You get it in these inefficient pockets, like in the price of a shelter, but that doesn't have, these knock-on effects through the rest of the economy. And that's, I think, why it's a self-undoing phenomenon. This, again, excess credit, it isn't trickling into excess wages, and it's not going to be able to drive excess spending going forward when we've already got, debt in the world is like 320% debt to GDP. We've never seen anything like it.
No, definitely not. Definitely not. Interesting. Just to see it, I get the arguments. Maybe we're going to get into helicopter money soon. That would certainly be inflationary and would certainly, make consumer prices go up. I mean, it's a weird thing because the measure out there doesn't really cover it. And in the U.S., housing is back up to pre-2007 peaks in many markets. Not all, but many.
So that only took 12 years, right? Yeah. And this is what I keep trying to warn Canadians, for example, is that when you get these really outperforming periods in an asset class, like we've seen in real estate, when it goes up at 3 and 4 and 5 times the normal historic rate, what you tend to get is a significant drop and then a decade or more of sideways action before you can reclaim those prior peaks. Another good example when we're talking about commodities is oil, right? So we've had an inordinate jump in supply and different ways of getting fuel out of different deposits. And what has that done? That has flooded the market and brought the price down. And it's been, from the peak in 2008 and the recovery into 11 were significantly lower with oil, even with all the clashes around the Iranian and the UK tanker episode last week and all the strain in the Gulf of the Gulf area. You've got oil floundering, and that's an example of tons of supply. If you think of that like tons of supply of credit, tons of supply of liquidity, can drive prices into bubbles and busts, but it can't sustain demand, and that's the problem right now with oil. As you've had this big surge in people wanting to sell it and the availability of it through technical innovation. And you've got all these cash-strapped emerging markets desperately wanting to dump whatever they can to get cash flow. Again, you see that the price can't rally sustainably in this environment. And that's why, supply is literally swamping demand. So I think the same thing is happening with inflationary expectations, where people are thinking, well, surely we're getting a lot of credit flow here. We should see, an inflation pickup. But again, if it goes into non-productive things and it doesn't actually impact wages and it doesn't increase the ability to consume, you're not going to see inflation. You're going to see disinflation.
All right. Well, I guess that's the big question. I'm not convinced that disinflation, in the face of all of this credit that's been created, if it's going to go down, then we're going to have major, severe economic disruptions here. Well,
we will, but ultimately, what's the bonus? Like, what's the payoff? When asset prices come down, you get affordability, right? So it's better for a struggling economy to have cheaper oil prices. It's better for a struggling economy to have cheaper shelter costs. So these things will be ultimately be part of the healing process, or the way to get consumption revived. In the past, for 30 years, all they had to do was cut rates, make credit more available, and they could boost consumption some more. At the end of that road, where I think we are essentially right now, they can only cut rates a little bit more. They can't increase wages. They've tried. They're basically at the best they're going to get this cycle. And then you've got these people with these crushing costs of whether it's education or whether it's shelter, unable to increase their consumption. And so that's why you get the end of the cycle typically. And that's what we're facing right now. All these policy maneuvers, try as they may, they're not achieving the stated goal. They've run out of their moxie, so to speak. And I think that's going to be the story, whether the U.S. Fed cuts this month, which they're supposed to, whether, you can move these talking heads around at institutions like, the heads of the IMF going to the head of the ECB and, all these different people. But essentially, they've only got the one playbook. That's all they ever did have, which was cut rates and hope for the best. Yeah. And now they're at the end of that.
They're out of bullets here for sure. Well, hey, thanks for filling us in there, Danielle. Make sure you take a look at Danielle's site, jugglingdynamite.com. Write us, email kl@kerrylutz.com. We'll catch up with you in a couple of weeks, Danielle.
Okay, thank you.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.